Welcome back to Trading Hour. Well, for now, it's looking like a pretty good screen, actually. If you look at the momentum movers on the upside, you have a lot of these names from the banking space, whether it's South Indian Bank, Union, IOB, J&K Bank, that are all up 8 to 10%. But just be a bit cautious because a lot of the, losers or laggards are also climbing. So maybe it's just a pop. Something like a Yes Bank, Zomato, etc. are also doing quite well. So just be a little cautious on the upside. But the IT sector is one of the biggest underperformers this year. Will we see a better 2023? Rima, what are the reports suggesting?
For starters, Nifty IT has been the worst performing sectoral index this year. It's down more than 25%. But bear in mind that this comes on the back of two very strong years. In 2020 and in 2021, the Nifty IT index had a gain of more than 50%. So here what we're presenting is the bull versus bear argument on IT stocks heading into 2023. We're going to tell you 4 reasons what could work against the IT names and 4 reasons what could work in their favor, and then you can decide which side of the fence you are on. So first, on the bear side, right? This is the bear case. What could be the things that go wrong? One, tech budgets. Remember, this has been, feared. Tech budgets are typically announced in January, sometimes in early February. Tech budgets may decline. 2, there is a risk that tech budgets this time may be short-term. It may not be for the full year annual budgets. You may say, you may have companies saying that perhaps this time we're going to outline a tech budget only for 3 months, 6 months, because there is too much uncertainty. And there is also a risk that even if a company says that I'm going to be spending 5% on my tech budgets this year, the actual spend could be a lot lower because as the year progresses, their financial condition is deteriorated and they do not have that 5%. So there could be a divergence between what the companies allocate as tech spend and what the actual spend could be. Number 2, a sharper than expected, a sharper than feared downturn in the United States. There is a very strong correlation between the US GDP growth and the IT services growth. So this is the Credit Suisse analysis where they're saying that current consensus is that US GDP growth will be 0.6%. In that case, IT companies, the top tier IT companies, will see about a 7.5% growth in FY24. However, if we get into a deeper recession, look at the way the top line growth will come down. In the bear case, if US GDP growth contracts by 1%, we're looking at a revenue growth falling from 7.5% to 5.7%, and that could drive further EPS cuts. Remember, up until now, the decline in IT names was more on account of PED rating and not so much as EPS cuts. Point number 3, premium valuations. Despite the valuation derating, Indian IT companies still trade at valuation premiums compared to the pre-COVID average. And the last point is mid-cap IT. Mid-cap IT could be far more vulnerable on account of a couple of reasons. One, client concentration. They have a lot of dependence on a few large clients, and if there is weakness in any of these clients, their revenues get disproportionately affected. Secondly is vendor consolidation, which basically means that earlier a client would say, I'm going to give all these 5 companies, small deals, right? They're going to have 5 small deals. Instead, they will say, I don't want that hassle. I just want one large company who will do all my deals together. That tends to hurt the mid-cap IT companies. And third, mid-cap IT companies have a lot of dependence on short-term deals. But those short-term deals have been impacted due to uncertainty. But now let's get to the bear case. For one, IT stocks have been consistent wealth creators. Look at the 3-year, look at the 5-year, look at the 10-year CAGR return of the IT companies, and you would see that they've been giving you a growth rate of close to about 20-odd%. Right through all the cycles, Indian IT companies have performed. Names like TCS and Infosys are not created in the day. They've got decades of work experience. They've proven themselves in digital transformation. They have adapted themselves to the new reality, and these are companies which benefited as the digital transformation went underway. Also, IT companies have gone through one year of time correction and significant valuation correction. So a bulk of it perhaps may be behind us. And finally, the 4th reason is cloud adoption and migration is a multi-year tailwind. Even if things slow down, it cannot be reversed. So this is a cycle which is expected to last over a couple of years. So it can pause, but it cannot be reversed. So those are just a couple of reasons that I wanted to put on forth on the bull versus bear case for Indian IT as we step into 2023. All right, let's get chatting about the technicals then.
Let's do that, Rima. Very interesting, and it really throws up